Welcome back to ASX Market Pulse. Today we're answering one of the most common questions asked by Australian investors. How much dividend income can $100,000 actually generate? It's a simple question, but the answer can have a huge impact on your financial future. Whether you're building a retirement portfolio, looking for passive income, or simply trying to understand how dividend investing works, this video will walk you through the numbers, the strategies, the risks, and the realistic expectations. By the end of this video, you'll have a clear understanding of what a $100,000 portfolio can achieve and how that income can grow over time. When most people first hear the phrase passive income, they imagine money arriving in their bank account while they sleep. They imagine owning assets that work for them rather than constantly trading their time for money. Dividend investing is one of the most popular ways to pursue that goal. Instead of relying solely on share price growth, dividend investors focus on receiving regular cash payments from the companies they own. These payments can be used to cover expenses, reinvest for future growth, or create a steady stream of income during retirement. Before we calculate any numbers, let's quickly understand what a dividend actually is. When a company earns a profit, management has several choices. They can reinvest those profits into the business, pay down debt, acquire other companies, or return a portion of those profits to shareholders. When they choose to return profits to shareholders, those payments are known as dividends. If you own shares in a company that pays dividends, you receive your share of those profits based on the number of shares you own. One of the reasons dividend investing is so popular in Australia is because many of the country's largest companies have a long history of paying dividends. Australian banks, telecommunications companies, infrastructure businesses, utilities, and mining giants have often rewarded shareholders through regular dividend payments. This has created a strong dividend culture among Australian investors, particularly those focused on generating income from their portfolios. Now let's talk about yields. Dividend yield is one of the most important numbers in dividend investing. Dividend yield tells you how much income you receive annually relative to the amount invested. If a stock pays a 4% dividend yield, that means an investment of $100,000 would generate approximately $4,000 per year in dividend income. A 5% yield would generate $5,000. A 6% yield would generate $6,000. At first glance, this seems straightforward. However, many investors make the mistake of focusing only on yield. They see a stock paying 8% or 10% and immediately assume it's better than a stock paying 4%. Unfortunately, investing doesn't work that way. Higher yields often come with higher risks. Sometimes a high yield exists because investors believe the company's future is uncertain. If profits decline, management may reduce or eliminate the dividend. When that happens, investors can lose both income and capital value. Let's start with a conservative scenario. Imagine you invest $100,000 into a portfolio of high-quality Australian companies with stable earnings and strong balance sheets. This portfolio may include major banks, infrastructure companies, and mature businesses that prioritize shareholder returns. Such a portfolio might generate a dividend yield of approximately 3.5%. On a $100,000 investment, that equals around $3,500 per year. Broken down monthly, that's roughly $290 per month. Now, $290 per month probably won't change your life overnight. You're not going to retire on that amount, but it's important to understand the perspective. Passive income doesn't have to replace your salary immediately. $300 per month could pay your electricity bill. It could cover internet expenses. It might pay for fuel, groceries, or insurance premiums. Most importantly, it represents income generated by assets rather than labor. Many experienced investors view their first dividend payments as proof that the system works. The amount may seem small initially, but it demonstrates that money can indeed generate more money. Once investors experience this firsthand, they often become more motivated to continue building their portfolios. Over time, those small payments can grow into something much more significant. Now let's consider a balanced portfolio. This is where many long-term investors position themselves. Instead of focusing entirely on income or entirely on growth, they seek a combination of both. A balanced portfolio might include dividend-paying banks, telecommunications companies, mining companies, and diversified exchange-traded funds. Such a portfolio could reasonably generate around 5% annual yield. At 5%, a $100,000 investment would generate approximately $5,000 per year. That's roughly $417 every month. At this stage, the passive income becomes much more noticeable. $400 per month could cover a car payment, help with rent, contribute toward mortgage expenses, or fund a monthly investment contribution into another asset. The beauty of a balanced portfolio is that it often provides both income and growth potential. Investors receive dividend payments while also participating in long-term increases in company value. Over long periods, capital growth can become an even larger contributor to total returns than dividends themselves. Now let's examine the higher yield approach. Some investors prioritize income above all else. They seek stocks, property trusts, infrastructure funds, and other investments that provide elevated dividend yields. A well-constructed income-focused portfolio may generate yields between 6 and 8%, depending on market conditions and asset selection. Let's assume a 7% yield. $100,000 invested at 7% generates $7,000 annually. That's approximately $580 every month. For many households, that amount can significantly offset living expenses. However, investors should understand that higher yields are rarely free. There is usually a trade-off somewhere in the form of higher business risk, lower growth potential, greater economic sensitivity, or reduced financial flexibility. One of the biggest mistakes investors make is chasing the highest yields available. They see a stock yielding 10% or 12% and assume it must be an incredible opportunity. In reality, unusually high yields often signal underlying problems. The market may expect future earnings declines. There could be industry disruptions, excessive debt, or other challenges affecting the business. As a result, investors should always evaluate the sustainability of dividends rather than focusing solely on yield percentages. Let's shift the discussion toward one of the greatest advantages available to Australian investors: franking credits. Franking credits are a unique feature of Australia's tax system and can significantly enhance the attractiveness of dividend investing. Many Australian companies pay fully franked dividends, meaning company tax has already been paid on the profits being distributed. Depending on your tax situation, franking credits may increase the effective value of your dividend income. For retirees and lower-income investors in particular, franking credits can make dividend investing even more appealing. This is one reason Australian investors have historically favored dividend-paying stocks compared to investors in many other countries. The tax benefits can improve overall portfolio returns and increase after-tax income.